I want to tell you a story about Bob and Mary. Bob and Mary are just two of the most wonderful people you could ever meet, and they had done everything that they thought was right. They had done everything that they were told was that they should do as they gear up for retirement. They're now retired. They're 75 years old. They've been retired for a little over 10 years now, and Bob is collecting Social Security of $30,000 a year. By the way, just so you know, Bob actually started his career right out of high school as an apprentice, and Mary was his high school sweetheart. And like I said, just two of the most amazing people you could ever meet. Bob worked for a company that offered him a defined benefit plan. You know that as a pension. And when he retired, he started receiving a pension of $2,000 a month. He actually took a reduced amount known as the survivorship option so that if God forbid something happened to him, Mary wouldn't see a reduction in income, at least as far as the pension's concerned. So he started receiving $24,000 a year, actually was receiving $24,000 a year from that pension. Now, Mary, she worked outside the home, mostly part-time for her career, but she also took some time off to raise the children and things of that nature. So instead of drawing Social Security on her record, she actually took the spousal benefit because half of Bob's record was more than Mary taking on her own record. So she started receiving $15,000 a year from Social Security. And at the time of their retirement, that is all the income that they needed in order to maintain their standard of living. They didn't need or really want to take any other income besides that. Unfortunately, though, they were forced to start taking more taxable income because when they killed the pension plan that Bob was a part of 20 years ago, his company started a defined contribution plan. You know that as a 401k plan. And Bob did what was recommended. He started throwing some money into the 401k plan, and that money grew and grew and grew, but they really don't need any of it because, like I said, they have the income that they need from Social Security and pension. But that 401k is now worth $500,000, and they have to start taking required minimum distributions off of it. So at 75 years old on a $500,000 IRA, that required minimum distribution is right around $20,000. And that is the totality of their income that they're taking. So they're taking income, or they have income of around $89,000 a year. Now, do they pay tax on $89,000? No, we have a progressive tax system. So the first thing that we need to do is they get to take some deductions. They get to take a standard deduction, so married filing joint, that's $27,700. Since they're both over the age of 65, they get an additional deduction of $1,500 apiece, so that brings their deduction total to $30,700. For easy math for me, I'm just going to call it $31,000. So if we take off their deductions, that leaves their taxable income of $58,000. And if we look at the tax brackets right here, that makes them fall squarely in the 12% tax bracket. Now, do they pay 12% on $58,000? No, we have a progressive tax system. So they pay 10% on the first $22,000, and then they just pay 12% on whatever leaks into that 12% tax bracket. So when we take that into consideration, their tax bill is actually $6,520 right here. Now, when these tax laws expire that we're currently under, their tax bill is actually going to jump to $10,137, a difference of $3,817. Because if you didn't know, that Tax Cuts and Jobs Act that was passed in 2017, that expires on December 31st at 11:59 p.m. 2025. And we're going to go from the brackets that we're currently in to the 2017 brackets, and all Congress has to do is nothing in order for that to take place. But here's what I want you to know is, what did the Trump tax cuts not fix? What does Biden's new tax bill, what's that not going to fix? Or what's the next one not going to fix? Well, what happens if something happens to Bob or Mary? Now, we do a lot of fun events throughout the year for our clients, and I have to admit that I don't particularly like golf, but we have a lot of families who do like to golf. And if you're a family that we serve, maybe we'll end up on the golf course together one day. But I did find myself on the golf course one day with Bob, and we're golfing. We get up to the first par 3. Bob pulls out a 7-iron, does a little wiggle, hits a smooth 7-iron shot right at the hole, bounces one time, goes in. Bob gets his first hole-in-one. He's so excited. He launches his club. He's jumping up and down, and all of a sudden, Bob's ticker gives out right there. Unfortunately, Bob is no longer with us. What income will Mary lose? Well, in case you didn't know, when one spouse passes away, you get to keep the larger Social Security check, but you lose the smaller Social Security check. So that $15,000 that Mary is getting, that's going to go away. Now, fortunately, like we mentioned, Bob took the survivor benefit on the pension plan. So none of that's going to go away for Mary. She's still going to get that $24,000 a year. And the great news is for Mary is even with that reduction in income, because that required minimum distribution was always gravy for them, she's going to be fine on income. But how is the tax code treating her now? Well, Mary now has $30,000 from Social Security. She has $24,000 from the pension, and even though your required minimum distribution is likely to increase a little bit each and every year, we're just going to assume that the required minimum distribution for our example, is $20,000. So we total all that up, and Mary's income is $74,000. All right, so good to go so far. She doesn't have to pay tax on $74,000 because she's still going to have some standard deduction. She's still over 65, so she's going to get the deduction for that. And like I mentioned before, she has some less healthcare costs, she has less clothing costs, she has less food costs. So from an income standpoint, she's doing okay. We want to see how she looks from a tax standpoint now. So like I mentioned, she's now a single filer, so the standard deduction for a single filer is $13,850. She still gets that over 65 deduction of $1,500, so that's a total of $15,350. Again, for easy math for me, for my sake, we're going to call that $16,000. So we minus out her deductions, and what do you know? Look at her taxable income. My goodness, does that not look familiar right there? But let's see what happens to Mary now. She's now a single filer, so she's over on this side of the equation. She's above $44,000, but she's below $95,000. She's in the 22% tax bracket. She just jumped 83% in her marginal tax rate, the single biggest jump in the tax code. Mary's top marginal income tax bracket is now 22%, and once these tax cuts expire in 2025, she's likely to jump to the 25% tax bracket. Mary's tax bill with 17% less income is now $8,067 compared to the $6,520 when Bob was alive. A 24% increase in taxes. Is that fair? No, it's absolutely not fair. Can I fix it? Not after Bob hits the hole-in-one. But luckily for you guys, I have a silver DeLorean parked out back, and if we get in it, if you get in it with me and we get that accelerator up to 88 miles an hour, we can go back in time. So let's do that. Let's go back 15 years, and I'm sitting down with Bob and Mary for the first time to do financial planning for them, and now they're 60 years old, and they sit down with me, and Bob says, "Hey Spencer, I have this IRA. We'll use the numbers we're going to keep the numbers the same just to keep it easy. I got $500,000 in this IRA. We have all the income that we need, that we're planning on spending in retirement between Social Security and pension. We just want to grow this money and leave it behind to our kids. We really don't need it." Hear it all the time. And maybe that's not necessarily you. Maybe you don't have a pension and you're going to need to pull some money off of your retirement accounts, but maybe your goal is to leave some money behind to your children. Even if it's not, you're still going to want to take advantage of some tax mitigation strategies anyways. But I look at Bob and Mary and I tell them, I say, I don't want you to do that. Obviously a little bit surprised because they said, we just want to grow it. We just want to grow it, leave it behind to our children. I tell Bob and Mary, I don't want you to do that. And like I said, a little bit surprised. They said, no, please, seriously, that's all we want to do. We just want to grow it and leave it behind. And I say, you know what? Let me show you what that looks like. Now I have to make an assumption, so I'm just going to assume a rate of return of 6%. So Bob, if we grow this money and keep deferring it, doing what it has always been done, when you get down there to age 73, you're going to have to start taking required minimum distributions. And at the end of 13 years, if we're able to get 6%, that $500,000 will be just over double, so a little bit over $1 million, and you're going to have $1 million in your IRA that you now have to start taking something called a required minimum distribution off of. And that required minimum distribution is going to be around $40,000 a year, and you're going to have to pull out $40,000 a year just so you have the luxury of paying the IRS taxes on that money each and every year. And oh, by the way, that required minimum distribution is likely to grow each year so that you have to pay more and more in taxes as things goes on. So let's assume that at least one of you makes it to age 90. After you've pulled out over $1 million in distributions, in required minimum distributions off of that IRA, there's still going to be $1 million left in that account that's going to pass 100% taxable to your children. And their whole goal was to help their children. And don't get me wrong, inheriting taxable money is better than inheriting no money at all. But I want to tell you something. There was recent legislation that was passed here in the last several years. One piece was the Secure Act. That was passed in December of 2019. The other was passed in December of 2022 called the Securing a Strong Retirement Act. We just simply call it Secure Act 2.0. And when it comes to the Secure Act and the Secure Act 2.0, those two pieces of legislation together raise the required minimum distribution age to age 73. Most people are aware of that, but what they're not aware of is that it changed the way IRA money or retirement money gets inherited by a non-spouse beneficiary, aka a child. And what it says is now a child who inherits money, unless certain very specific parameters are met, they have to have that IRA money depleted within 10 years. They can no longer stretch it out over their life expectancies. So what that means, or to add insult to injury, is most children will inherit that money when they're in their 60s. So now they're earning more money than they've ever earned in their career, and they have to take this substantial distribution off of this inheritance that they've received because they have to have it depleted within 10 years. And when you combine the fact that when you combine the fact that they're making more money than they ever have before and having to take this high distribution, it's likely that that's going to bump them, or at least has the potential that it's going to bump them into a higher tax bracket. So basically what we've seen through the Secure Act is there's over $35 trillion in retirement assets across the United States. And I can't think of a larger untapped bucket of money the federal government has to go to in order to increase tax revenue. And like I said, through the Secure Act, what the Congress has shown us is there are some clever ways that they can increase tax revenue off of different accounts that exist, rather than just simply raising taxes and having to deal with the hype that goes along with raising taxes. So back to Bob and Mary. Bob and Mary leave $1 million behind. They have 3 children, so that's $385,000 to each one of their children, roughly. They have to take out $38,500 each year plus interest over 10 years, which, like I said, will likely hit them during their peak earning years, and they'll have to take that distribution, which will likely bump them into a higher tax bracket. So if we're lucky, the IRS only gets their hands on $420,000 of that $1 million that Bob and Mary left behind. So I'm going to write that number down right here, $420,000 of the $1 million that Bob and Mary left behind. On top of that, remember, Bob and Mary were taking required minimum distributions the whole time. So the taxes on those required minimum distributions is about $225,000. So if you're keeping track with me, if we add that up between what Bob and Mary are required to pay in taxes off of their required minimum distributions and what the children will most likely have to pay between federal, state, and local tax, that's $645,000. Oop, right there. Sorry, a little bit unlegible, but $645,000 in taxes on an IRA that was once worth $500,000 today. And those are conservative estimates. If you have $1 million IRA, then double that number. If you have a $250,000 IRA, then cut it in half. Either way, I believe there's a better way. So I tell Bob and Mary, I don't want you to do this. What I want to do for you is I want you to go a different route. I want to open up an account for you called a Roth IRA. And Bob says, I'm retired. I'm not going to have any earned income. I can't have a Roth IRA. That's not true. Anyone, an octogenarian, a newborn baby, can have a Roth IRA. There's several ways that you can get money into a Roth IRA, and one of those ways is something called a Roth Conversion. So what I tell Bob and Mary is I want to open up a Roth IRA for you, and I want you to start contributing to it. Because if we look at this tax bracket again, I remember I mentioned their taxable income was $58,000. Well, the 12% tax bracket goes up to $89,450. So there's roughly $31,000 of wiggle room that they can start doing Roth conversions on. Now, we're not going to play it all the way up to $89,000 because I don't want to inadvertently bump them into the 22% tax bracket. So we just say, hey, we're going to convert around $30,000 a year. And we're going to do that. We can do that all the way down to zero and just pay 12% tax on that $30,000 a year. But I just tell Bob, you know what, we're just going to do that until you hit required minimum distribution age. Now, when we convert $30,000 from a pre-tax IRA to a Roth IRA, is that taxable? Absolutely it is. And they're going to pay about $4,800 in taxes between federal and state to get that money into their Roth IRA. So there's about $25,000, I'm rounding here, but there's about $25,000 that's going to go into that Roth IRA each year for 13 years until Bob hits age 73. And if we just make 13 deposits into Bob's Roth IRA at roughly $25,000 a year, let's assume that it's invested in all the same stuff. We're still assuming a rate of return of 6%. Let's flash forward to age 90 again. There's no longer $1 million left in the IRA because we've been taking those distributions. There's $541,000 left in that IRA. That's going to pass fully taxable to their children. But the Roth IRA now has $1.3 million in it that's going to pass 100% tax-free to their children, which effectively doubles the net inheritance of the children, all while saving Bob and Mary and their children over $280,000 in taxes over the life of that IRA. And that's even taking into consideration the fact that I mentioned that they're going to be in a higher tax bracket once these tax laws revert back to where they were prior to the tax cuts that we're currently under. So I even took that into consideration. So whether you're in the 12% bracket, the 22, the 24, the 32, it doesn't matter. Properly executed, this strategy can save you, it depends on your situation, but can save you hundreds of thousands of dollars in taxes and put more money in your pocket, provide more to your beneficiaries. So if that's the type of advice you're looking for, then we may be a firm that you want to talk to. And I have so enjoyed doing this video. I love talking about taxes, mainly because I believe taxes is one of those areas that we can really serve families and help them save on money and basically add money to their nest egg by helping them keep more of it in there. Conservative Financial Solutions' vision is to be the leader in helping families make great decisions so they can live longer, happier, and more fulfilling lives. And tax planning and retirement planning is just one of those ways that we're able to do that. My name is Spencer Ford, CEO and Wealth Advisor with Conservative Financial Solutions, a certified financial planner professional. If you enjoyed this video, please hit subscribe and ring that bell icon so you know when there's another video coming out, and we'll see you in the next one.